Are you looking at using a company to run your business? Or maybe you're already using one and want to better understand the tax side of things. Well, today's video is for you. Hello everyone, my name is Ethan Rooshock and I'm the director here at Rooshock Accounting, and today's video is all about company taxes. I'm going to go through the fundamentals of company tax here in Australia, including the rate of tax, how to calculate the tax, and what strategies you can implement to get funds out of your company without incurring penalties. And of course, make sure you've hit that subscribe button so you can get more tax tip videos directly to you. Anyway, let's get into company taxes. A company is a separate legal entity and it is taxed differently to how individuals are taxed. So individuals in Australia are taxed on a marginal tax rate system. And as you see here, there's a range of different tax rates depending on where your income is falling. Whereas a company is taxed at a flat rate. So we have two different rates for companies. We have the base rate entities, which are currently taxed at 25%. And then we have all other entities which are taxed at a flat rate of 30%. So this is a much simpler calculation because we're purely going to take taxable income times by tax rate to work out the tax owing. So you're probably going to know, well, am I a base rate entity or do I fit into this all other entities category? And there's two main tests that you have to work out. The first is on turnover. So if your aggregated turnover is less than $50 million from 2022 onwards, then that's the first tick to being a base rate entity. The other area is in regards to what type of income you've got. So you need to have 80% or less of your income be non-passive income. So passive income is like dividends or royalties and rent, interest income. So pretty much you're trying to prove that you're mostly running a business through this entity. So for example, if you're running an accounting firm, then all your income is going to meet this need and you're going to be a base rate entity. Versus maybe you've got investments, so you just hold shares in this company and just receive dividends, then that won't meet that requirement because 100% of your income in that situation would be passive income and therefore you'll be taxed at the 30% rate. Now we've determined which rate it is, well, how does the company determine its taxable income? And it is quite a simple calculation at a basic level because it's purely going to be income less expenses is going to be profits. So for example, we're going to take a cafe and they're going to have their food and drink sales is going to be their income. Then they're going to have their expenses, which will be their wages, their food costs, their electricity, maybe they're paying rent or any other overheads they've got. And then we're going to get our profit. So we might have $100,000 of income, we've got $40,000 of expenses, and we've got $60,000 of profit. Now we've determined that this is a base rate entity because we're running a business through it. So we can now do our calculations for our tax. So we've now determined our taxable income is $60,000, our rate is 25%, and we purely do that calculation and that leaves us with $15,000 of tax that the company would owe. Now, if you've had tax withheld throughout the year, maybe you've been paying some pay-as-you-go installments, that will come off, and then you would get a final amount payable. Now, if for some reason those installments had gone over that $15,000, then you'd be in a refund position. Now, just be aware there can be a difference between the accounting profit of a business and a tax profit of a business. This is a more complex topic, but things like depreciation can run at different rates. So make sure you speak to your accountant about that so you really understand what is the taxable income of your business. Now, one of the challenges with a company is that because it is a separate legal entity, then you need to be careful when you're withdrawing funds from the company because those funds aren't the directors. They're not the shareholders, they're the company's funds. Now, the good thing is there are multiple ways that you as the owner of the business can get funds out of that company. And the common ways are wages, directors' fees, dividends, or loans. So for a lot of people that are running their business through a company, they will likely be paying themselves a wage. So this wage is paid to them, they pay tax on that wage, they pay super on that wage, and it's just treated like any other employee. And then this wage is taxed in your personal income tax return at individual marginal rates. The other option might be directors' fees. They work very similar to wages. They're more used for directors that are maybe non-working, or maybe they're just doing some advisory work for that company, but they are definitely an option as well. We also have dividends. So once the company start turning a profit and they start lodging tax returns and they start paying tax, they want to get some of these taxed funds out to shareholders. So they may pay a dividend out and they may have franking credits attached to that then flow through to the individual tax returns. The other option is loans, and this typically happens where someone just draws money out of the business because they don't really understand how it works, and now they owe the company money. So this can cause major issues because they now owe the company money. And this goes into a whole another complex section called Division 7A, where you're going to need to repay this over a certain period of time, and you're going to be needing to pay interest on it as well. You really want to be very careful if you end up going down this path. So the easiest way to avoid this is don't just draw funds out of the company account and use them for personal matters. Speak to your accountant first so you really understand is this the best way to be doing it, or should I just be upping my wage, for instance? The easiest way to understand it is that it's not your money, it is the company's money. Therefore, don't use it for personal matters unless you understand what you're doing. So in summary, a company is a separate legal entity. It will be taxed at a flat rate. It'll be taxed on its taxable income, and you need to be very careful when withdrawing funds from your company to make sure you understand what you're doing so you don't end up in a Div 7A nightmare. I hope this video has been helpful. Drop a comment down below on what you want me to cover next. I'll see you on the next one.